Natural gas futures nudged higher early Friday after a brief dip, but let's not mistake this for a clean reversal. The market's been under steady selling pressure in recent sessions, and that didn't happen by accident. Volatility remains high, with price action bouncing around like it's chasing headlines. That said, Friday's trade is flirting with a potential support zone, but it's far from convincing. Given the broader setup, this looks more like a setup for fading rallies than chasing them. Unless something shifts dramatically, any upside from here may be short-lived and met with fresh selling. Spot gas prices at the Waha hub in West Texas hovered near 7 cents for the second straight day, scraping levels not seen since late May, when the hub briefly dipped into negative territory. Traders pointed to ongoing pipeline constraints, including maintenance on Kinder Morgan's Gulf Coast Express, as the culprit behind the price slump, with excess supply effectively stranded in the Permian Basin. Storms may occasionally lift gas prices by disrupting production along the U.S. Gulf Coast, but more often than not, they do the opposite. When LNG export terminals go offline and power outages hit homes and businesses, demand takes a hit, and so do prices. With roughly 40% of U.S. electricity coming from gas-fired plants, any widespread blackout can quickly flip the market narrative from bullish to bearish. Average natural gas output in the U.S. has dipped to 107.4 billion cubic feet per day so far in September, down from August's record-setting 108.3 billion cubic feet per day. While that's a modest pullback, it's hardly enough to shift the supply narrative. Meteorologists expect above-normal temperatures to linger through at least September 27, which should give a slight boost to gas-fired power generation as air conditioners stay busy. Still, demand growth looks tepid. Total U.S. gas demand, including exports, is projected to rise from 101 billion cubic feet per day this week to 102.6 next week, and 102.9 billion cubic feet per day the week after. Notably, next week's forecast came in softer than Thursday's outlook, adding to the cautious tone. On the export side, LNG feed gas flows are on track to hit a 3-week low of 15 billion cubic feet per day on Friday, dragged down by declines at several major facilities. Cheniere's Corpus Christi and Sabine Pass, Venture Global's Calcasieu and Freeport LNG have all seen reduced activity. Adding to the export headwinds, Berkshire Hathaway's Cove Point terminal in Maryland is scheduled to shut around September 15 for a month-long maintenance cycle. In short, while warmer weather may offer a flicker of support, softening demand and export flows continue to weigh on the broader outlook. The $3 mark sits right in the middle of the current range, and being a big, round, psychologically loaded number, it naturally draws attention. That alone gives it some weight as a resistance level. Traders are likely watching for short-term pops with long upper wicks, classic setups for fading strength. I still think we've got one more leg down before the market starts seriously pricing in winter premiums. There's an unfilled gap lurking near $2.80, and it wouldn't be surprising to see the market gravitate toward it before any meaningful shift in sentiment. We're trading the October contract now, which is cooler than September, sure, but it's still not prime heating season. So unless something dramatic changes, rallies in this zone may be more about positioning than conviction. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.